to the weakest rating at the bottom. Now, first of all, let me tell you what a sovereign rating is, because it is often misunderstood. A sovereign rating is a rating of the balance sheet of the government. It is not a rating of the economy or the sum of all the enterprises of the economy as a whole. As an Indian national, one of the things when in the early years when I joined S&P and I used to go to India, everybody used to say, why is India speculative grade? Isn't it investment grade? You look at the huge prospects and so on. And one of the things that people over there were not sensitive to was this was not a rating of the country as a whole. It was a rating on the balance sheet of the government. And so if there's a lot of debt and there are other factors that can influence that rating, they should be borne in mind. Now, first, let me just talk about those five broad headings that are there. Political risk here refers to political uncertainty, political instability, because that has a huge implication on a government's willingness to pay. The economic structure and prospects, that's something that I've just talked about, which is the economic structure of the economy, the GDP growth, and so on. The next is fiscal flexibility, which is the ability to balance the budget, to have surpluses, or manage deficits so that they don't run out of control. And it's the ability to raise taxes and income from a variety of sources, but at the same time to be able to put the lid on expenditure so that it doesn't go out of control. The fourth column is on monetary flexibility and the ability of the government to manage both interest rates and exchange rates for stability and to support growth. And finally, it's the external finances, which is the forex reserves and holdings, external assets of the government. So these are broadly the five factors that go into influencing the sovereign rating. That's part of our criteria. And what the shades of green and red are, the green is supposed to indicate that these factors have a positive implication. The yellow is meant to indicate that it is neutral, and you can see there are shades of gray and there are shades of red, and red is meant to indicate that factor at the moment is viewed by the Standard & Poor's sovereign rating team as a negative. Now, if you look at how sovereign ratings have performed over the last 10 years, what you have, again, is the way this data has been sorted is those countries which had the maximum number of upgrades over the last 10 years are listed at the top and so on. Now, China got upgraded fairly recently to AA minus, and it's had a 5-notch upgrade over the last 11 years. And there are basically a few simple things behind that. First, China has had exceptional growth, and I think you've seen some of the data. It's been in excess of 8% for a very long time. It's also been able to have both macroeconomic and financial stability, and some people say that it is quite obsessed with ensuring stability in its markets, and that is its main objective more than anything else. The third factor behind that is also that China has fairly low government debt. And finally, we all know that China has got almost $2 trillion in reserves, so it has a very strong external asset position. Let's move to India, which has also seen a 2-notch upgrade in these last 10 to 11 years and moved from a speculative grade category to the investment grade category. And again, few simple things: consolidation of debt at both the center and the state level, a greater amount of financial flexibility. It's certainly looking to hold back and maintain expenditure so that it's not too high relative to overall GDP. And then one of the other things that India has begun to enjoy over the last 7 or 8 years is a very strong growth and continued growth, strong growth prospects. Now, Indonesia, which is the newest member of this big country club, if I may call it big country, because it's 300 million. After that, you see the next country, I think you're really talking about Vietnam at 70 million. So in the case of Indonesia, we've seen improving debt metrics. It's also been growing its forex reserves, and it's adopting a very cautious fiscal management policy. Now, in the case of Sri Lanka, we upgraded Sri Lanka in September of last year, and that was because of its strengthened external liquidity and the expectation that public finances would continue to improve. Now, while the previous slide had a lot of positives, the challenges that I had spoken about, the 5 challenges, you can see what inflation does. It creates both, it creates economic, social, and political challenges that I talked about. You also see asset bubbles forming. In particular, you've heard of asset bubbles forming in the property markets of Hong Kong and Singapore. And what that does is it typically leads to bad loans and NPLs in the banking system. Now, in the case of capital inflows, what that has been doing is it's been putting a lot of pressure on currencies, and countries have had to look at balancing interest rates and exchange rates to bring about stability. The impact of events in the Middle East, I will come to that in a minute, but the global structural imbalances that are being talked about is you've got America on the one hand, which is being so reliant on overseas goods and services and financing its deficits from overseas, that it is now looking to grow its external demand. And if you look at China, which is in the reverse or exact opposite position of the US, it's been investing a lot of its reserves in the US so that it manages to keep its currency under control and not appreciate too sharply, is now looking to grow its domestic demand so that it can balance any pressures that may come through from the external demand for its goods and services weakening. So you have the situation of the US looking to grow external demand and China looking to grow internal demand or domestic demand, and whether this is going to be sustainable or not, it remains to be seen. In the case of the European countries, what we have seen is that they've got fairly heavy debt burdens and budget deficits, and you can see it doesn't leave countries like that much room for flexibility. And in the case of Asia also, there are a number of countries who have already had stimulus packages. Their ability to fund or finance further stimulus packages may be constrained if they have to do that to stimulate growth. Now, the hot money that has been coming into Asia over the last year or so, if you can see, it is fairly sharply. The line in red is Indonesia. So, in 30% of the bonds, its domestic bonds are now held by foreigners. In the case of Malaysia, it's 20%. That's the line in yellow. In the case of Korea, it's about 10%. And Thailand and Japan are 6% and 4%. And you can see all of these have gone up quite sharply. Now, what the responses have been from the governments is actually been quite mixed, and I will share that with you. But just look at what these capital inflows are doing to exchange rates. So, exchange rates across much of Asia last year have gone up 10 to 15% as a result of these huge capital inflows. Now, the exchange rates strengthening can be a good sign because what it does is it helps governments manage inflation. So give you an example, Singapore has an exchange rate policy. It doesn't have an interest rate policy, and it uses exchange rates as a way of managing inflation. But what exchange rates strengthening can also do is it can make exports from a country less competitive internationally, and may not be something that exporters like here. Now, the tendency when you have exchange rates going up sharply and huge amounts of capital inflows taking place, so you really have to look at this chart from the bottom left to the top right to get an indication of where are the maximum pressures on governments to introduce capital controls. And what we have seen is that this time round, governments have introduced a variety of what we would call very targeted measures at tackling these capital inflows. Because what happens is when governments do fairly sweeping measures and introduce capital controls in general, Sometimes that may or may not have that desired effect, and it can lead to imbalances in the system. But in the case of Singapore and Hong Kong, what they did was the authorities introduced fairly tight and stringent rules for new investments in the property sector, because that was the one where the money was principally flowing into. In the case of Indonesia, what they did was, you saw that there was a 30% holding in bonds. So what they did was they introduced withholding taxes on those bonds with a view to cooling down the amount of money that was flowing in. And in the case of Thailand, what they did was they announced, a minimum holding period so that people would have to hold investments for X number of years, so that would cool down the money flows. Yeah. Now, the Japanese earthquake is fairly fresh in our minds, and as we speak, a clear picture is still not emerging on the extent of the damage and the implications on the economy. Some estimates that were announced by the Japanese government last week, I think I read something that it was a figure between 250 and 300 billion US dollars as the cost of, the sum total of the damage that had taken place to property and so on. Now, that is going to have a fairly long-term impact on the Japanese economy. And our sovereign ratings group last week said it was too early to tell what the implications would be. But in your packs, you will see some material which talks about specifics. One of the things that is very clear is that Japan is a big part of the global supply chain. And one of the examples I heard yesterday was that for German cars, there is a special type of paint additive that adds to the luster or sheen of the car, and the only place where it is manufactured in the world is in that Sendai, Fukushima area, and that factory is being shut. So as a result of it, people who are wanting certain shades of color for their cars may not be able to get that. So that's just an example of what the implications are for the supply chain. Now, what we have seen is the Japanese yen appreciating quite, strongly, and that shouldn't come as a surprise, because in a zero or low interest rate environment, you would have seen the Japanese private sector and individuals making large investments. Now, the same economist who I heard a couple of weeks back in Singapore was saying that the big investments made by the Japanese private sector were in the countries of Australia, New Zealand, Brazil, and South Africa. And his prediction was that, those currencies would be under maximum pressure as Japanese brought back their monies home to help them support the reconstruction of the economy. Now, the turmoil in the Middle East is ongoing, and it continues to surprise us every day. I think from an economic perspective, we've already seen it. Oil prices have gone up. The unrest shouldn't surprise us, actually, because you've got high unemployment among the youth, and there is a fair amount of political repression which leads to, or political suppression, that leads to disillusionment in these autocratic regimes. Yeah. Now, there are parts of Asia also which have fairly similar risks. There are ongoing tensions in a number of countries, and that's on the slide. There is the potential or risk of unrest in some others, but we believe that there are mitigating factors in these other countries that should help them tide through these difficult times. Yeah. Now, in conclusion on the economic and credit outlook, our view is that the sovereign ratings, we expect this environment to be relatively benign, that the ratings to continue the trends that we have seen. I've talked about the risks with inflation and asset bubbles, and the risks here stem from policy makers making mistakes in tackling them, and also if trade controls and protectionism comes in, which can derail some of the positives that we have seen. Now, while Asia's a lot of Asia is facing these challenges, we are approaching these challenges very different from 12 years back, because we are in a much stronger position today than before, and therefore we are better positioned to meet these challenges. The second thing that I had wanted to talk to you all about was what was happening in markets, capital markets, and the needs. and what are some of the priorities. And really, there are two aspects here. First, the amount of capital that is required to meet the funding needs for a variety of reasons here. Standard & Poor's estimates that for refinancing Asian debt and funding new projects, over 40 trillion US dollars will be needed over the next 10, 15 years. The banking sector, as we know, has been wounded, it's bruised. Its ability to lend because of a variety of reasons, including Basel II, Basel III. The banking sector is not going to be able to meet those needs. Now, when you look at Sri Lanka, you look at virtually 50% of funding comes from banking sector, 50% comes from the equity markets. And the trend generally is now for roughly the bond markets to contribute a third, the banking sector to contribute a third, and for equity markets to contribute a third. So we believe that stronger market mechanisms will be required so that capital can flow to enterprises that need them. In the case of infrastructure, and Sri Lanka again is another example of that, the amount of infrastructure needed across Asia for roads, transportation, water, power, and so on, the Asian Development Bank has put out an estimate that Asia needs $750 billion on an annual basis. And what that does is, while there is a need for infrastructure and the money, it also provides an opportunity for capital markets to be developed to finance that growth. The second trend, and this one also has implications for Sri Lanka, is the internationalization that we are seeing of local currency markets. Now, in the case of Sri Lanka, I know that there have been some bond issues that have taken place in Sri Lanka to raise money internationally, and I saw an ad in the papers from a telecom company here yesterday. But what we are seeing is also foreign issuers are increasingly active in Asian markets. Malaysia is an example. Indian issuers, Korean issuers, issuers from other part of the world are going into Malaysia, they're going into Thailand, they're going into Japan, as we all know, and Hong Kong. And they're going because they're driven by liquidity in these markets, the pricing is attractive, and they're able to meet their funding needs by coming in these markets. So that's one key element that we are seeing of foreign issuers accessing in markets, not necessarily in the US, but coming into our own markets in the region. The second thing that we are seeing is that global investors are increasingly holding local currency bonds and shares. And the reason why they're doing that is that the bond yield, so give you an example, if international investors are holding bonds in ringgit or they're holding in Thai baht, they're doing it because of the yield pickup, and also they're anticipating currency appreciation, and also they feel that the underlying growth in those economies is fairly strong, so that supports their making those investments. Now, the chart that you have at the bottom of this slide is showing how much of local currency bonds are there in each of these markets, and that's in yellow relative to the blue, which is the amount of bonds borrowed by companies and banks in those markets from overseas, so US dollar or euro bonds. And if you see that proportion, except for the Philippines and Indonesia, and virtually every country that I've got on this chart, you will see that local currency bonds are playing a much more important role in financing the needs of issuers in their markets in local currency. And therefore, what that means is for countries like Sri Lanka, what they need to do is to work on deepening their national bond markets and harmonizing practices across the region, because that must be a key priority. Now, I'm going to skip through this slide because, foreign issuers and investors, for the trend to emerge in Sri Lanka with where the markets are, I think we are still a couple of years away from that happening. But what foreign issuers and investors do is they bring in global best practices and help the markets reach sophistication much more quickly than if they were left on their own. A couple of months back, Standard & Poor's published a report on credit culture and the need for a credit culture across Asia and how it could be done to stimulate the growth of capital markets and bond markets in particular. Now, what we mean by a credit culture is the whole thing of philosophy, policies, and procedures. So I call it the 3 Ps: the philosophy, the policies, and procedures for managing risk. And what we are looking for is that risk needs to be measured, and after it's been measured, it also needs to be priced objectively, so that you have a risk management climate in a system that will support the growth of capital markets. Now, there are 5 elements in what we mean by the pillars of a robust credit culture. First is there should be transparency, and as accountants, most of us will understand that, because it means that there should be a high standard of disclosure, that accounting and reporting standards should encourage reporting that is full and fair, and that corporate governance standards ensure that the responsibilities to stakeholders are met with. In the case of independent objective analysis, here what we are looking for is the existence and availability of research. So it would be credit research from rating agencies, from fixed income houses, from other credit analysts, and something that is accepted by the market as being credible. Third is risk-based pricing. So what you see is, if you see a AA credit, you should expect it to be priced tighter than a single A and a triple B, and so on, so that investors are compensated for the additional risk that they're assuming. And so if that right rank ordering with respect to risk pricing exists in the market, that's a positive. The fourth item is very important, because this is what is about creditors' rights. So in the case of bankruptcy, are they able to enforce legal action fairly quickly through the courts and legal system? And finally, it's that there must be arm's length relationships between the government and the private sector, government and the banking system in particular, and also between issuers and investors, so that credit is placed appropriately and priced appropriately. Now, when we released that report at the end of last year, there were 9 countries in Asia. I've taken Australia off this, but this is just a snapshot of our assessment of these markets